Every single morning I wake up, and the first thing I do before coffee, before anything else, is I pull up the market data. And there are mornings where what I see genuinely stops me. February 23rd, 2026 was one of those mornings. Not because something dramatic happened overnight. Not because there was breaking news flashing across every screen. But because when I looked at the full picture, the price, the flows, the on-chain behavior, the institutional positioning, something clicked. The story this market is telling right now is one of the most important stories I have covered on this channel. And if you watch this entire video today, you are going to walk away understanding Bitcoin's current condition at a level that most people who have been in this space for years simply do not have. Because the price you see on your screen is never the real story. It is just the headline. What matters is everything underneath it, and that is exactly what we are getting into today. Let me take you back 48 hours first, because you cannot understand where we are right now without knowing where we just came from. 2 days ago, Bitcoin was sitting around $68,043. Quiet, range-bound, the kind of price action that makes casual observers lose interest and scroll past. Volume was present, but not explosive, and every time there was any upward attempt, a fresh ceiling of supply came in and capped it. That pattern, where recovery attempts keep getting sold into, does not happen randomly. It happens when there are participants in this market who are using every bounce as an opportunity to reduce their exposure, and the on-chain data confirms exactly that. Yesterday, February 22nd, Bitcoin slipped further to around 67,316, down roughly 1.75% in a single session. Volume remained elevated at approximately 9.3 billion across exchanges. People were actively repositioning, not sitting on their hands, but directionality was absent. And that absence of direction has a very specific cause that I am going to explain to you thoroughly in the next few minutes. To fully understand today, you need to understand what happened on February 5th, 2026, because that single day changed the character of this entire market cycle. That was the day Bitcoin crashed through $60,000, its lowest level since October 2024. One of the world's leading quantitative research desks described it as a 6 standard deviation event on their rate of change analysis. To put that in plain language, what happened that day was so statistically extreme, so far outside the range of normal market behavior, that it almost should not have been possible given the prevailing conditions. And it was not just the price move. In the days surrounding that event, the broader derivatives market saw roughly $2.5 to $3 billion in Bitcoin-specific liquidations. 580,000 individual trading accounts were forcibly closed. These were leveraged positions that had been building since October's peak of approximately $126,000. And on that single day, the market flushed all of them out simultaneously. Here is what is remarkable about that day, though, and this is the part that most people missed entirely because they were too busy watching their portfolios bleed, while retail traders were getting liquidated by the hundreds of thousands, while panic was spreading across social media, while fear in the market hit a reading of 5 out of 100 on the sentiment scale, lower than during the FTX collapse, lower than during the Terra crash, the worst single sentiment reading in this asset's history. On that exact same day, the largest single-day whale accumulation since 2022 was taking place. On-chain data confirmed that approximately 66,940 Bitcoin moved into accumulation wallets in a single 24-hour window. That is not a coincidence. That is the oldest playbook in this market playing out in real time, and it was happening in plain sight while everyone was too scared to see it. Now, fast forward to today, February 23rd, and here is where we stand. Bitcoin is trading around $67,500, down approximately 46% from its October 2025 all-time high of $126,000. The 20, 50, 100, and 200-day exponential moving averages are all sitting above the current price, which technically confirms that the broader downtrend structure from the October peak has not been broken. The MACD histogram bars are shrinking, which tells me something specific. It does not mean the downtrend is over, but it does mean the velocity of the bearish momentum is fading. Bears are losing energy. The RSI is sitting around 37, which is deeply in oversold territory on the weekly time frame. The price has been consolidating in a narrow band between $65,000 and $70,000 for most of this month. And that consolidation after an event as violent as February 5th is exactly the kind of base formation that historically precedes the next major directional move. $60,000 is the level I am watching more closely than anything else right now, and I will tell you exactly why in a moment. The sentiment picture is something I want to spend real time on because it is genuinely extraordinary. The market fear and greed reading right now is sitting in the extreme fear zone, currently around 10 to 15 out of 100. And I want you to understand what this number actually represents. This index synthesizes volatility, spot trading volume, momentum, social media activity, Bitcoin market dominance, and several other data points into a single composite reading. When it hits extreme fear levels this deep, it historically signals one of two things. Either the market is about to flush even lower into a final capitulation, or it is sitting right at the inflection point where the next recovery begins. The problem is you cannot know which one is happening in real time. What you can observe is the on-chain behavior of large capital allocators during these periods, and that behavior is the most important signal available right now. I checked the on-chain data this morning, and the ownership picture that is developing in this market is genuinely one of the most interesting structural stories I have covered. Here is what the data shows. Wallets holding very small amounts of Bitcoin, the retail layer of this market, have actually been accumulating. Their collective share of total Bitcoin supply has climbed to the highest level since mid-2024. Everyday investors are buying into this dip. They believe in the long-term thesis, and they are adding to their positions. Now, at the same time, wallets in the 10 to 10,000 Bitcoin range, the large and very large holders, the entities that typically drive major sustained price moves, those holders have been reducing their net positions since October's peak. They have been selling into every recovery attempt. And when you understand this divergence, the choppy, frustrating, ceiling every time price action of the last several weeks makes complete sense. Retail is buying. Institutional scale holders are distributing. And those two forces are roughly canceling each other out, which is exactly what range-bound consolidation looks like from the inside. Bitcoin at this moment does not need more retail participation. Retail is already here. What this market needs, what is missing, is for the distribution pressure from large wallets to slow down or reverse. When that happens, and when it is combined with the retail demand that is already present, the setup for a real recovery materializes. But here's the nuance that the broad narrative is completely missing. While the aggregate data for large holders shows net negative positioning since October, the mid-range whale cohort, wallets holding 10 to 100 Bitcoin, was the single most aggressive dip buyer during the February 5th flash crash. When Bitcoin briefly touched the low $60,000, that specific cohort stepped in with more conviction than any other group in the market. That is not casual participation. Those are entities with enough conviction and enough capital to deploy aggressively during moments of maximum stress. They were buying when the fear index was printing its lowest reading in crypto history. That divergence between sentiment and action, between what the crowd is feeling and what capitalized participants are doing, has historically been one of the most reliable structural signals this market produces. Now, I want to talk about the institutional landscape because this is where the story gets genuinely complex, and where most analysis you will find either oversimplifies or completely misreads what is happening. I went through every piece of data I could find on institutional flows this week, and the picture is not black and white. Since November 2025, U.S. spot Bitcoin investment vehicles have seen total net outflows of approximately $6 billion. That is a significant number. It represents real selling pressure because when large institutional funds redeem their units, the underlying Bitcoin held in custody has to be sold into the spot market to meet those redemptions. And that selling creates a feedback loop. Outflows lead to spot selling pressures price. Price pressure leads to more outflows from nervous holders, which leads to more spot selling. This cycle has been a genuine headwind on the market from October through now. But here is where BlackRock enters the picture. And I want to be precise about how I describe this because the nuance matters enormously. BlackRock manages $12.5 trillion in assets globally. They are the largest asset management firm on the planet by a significant margin. Their Bitcoin investment trust has become the dominant vehicle for regulated institutional Bitcoin exposure, holding approximately 786,000 Bitcoin in custody, with assets under management of roughly $54 billion as of earlier this month. Over the recent outflow period, their fund has been among those seeing net redemptions. The 5-week outflow from this fund alone has exceeded $2 billion. That is the reality of the current environment. But on February 10th, when the broader market was still digesting the carnage of February 5th, their fund recorded a $26.5 million net inflow in a single day. That is not a massive number on its own, but the timing tells you everything. Long horizon institutional asset managers were looking at Bitcoin around the $68,000 to $69,000 level and treating it as a strategic accumulation opportunity. Not panic, not capitulation. Deliberate positioning. And the institutional story does not stop at fund flows. What I found when I dug into the regulatory filings is arguably more significant than any single day's flow number. Jane Street, one of the world's most sophisticated quantitative trading firms, disclosed acquisition of approximately $276 million in Bitcoin ETF exposure in the fourth quarter of last year. Mubadala Investment, which is one of Abu Dhabi's sovereign wealth funds and represents some of the most patient institutional capital on the planet, raised its Bitcoin ETF stake by 45%, bringing its total exposure to approximately $630 million. Weiss Asset Management added positions worth roughly $107 million. These are not momentum traders. These are long horizon capital allocators with investment committees, risk management frameworks, and fiduciary responsibilities to their beneficiaries. The fact that they are increasing exposure during a 46% drawdown from all-time highs tells you something fundamentally different about their long-term conviction than what the short-term price chart suggests. And then there is the structural shift that I think is the most underreported story in all of crypto right now. 3 of the largest traditional banks in the United States, Wells Fargo, JP Morgan, and BNY Mellon, have all fully operationalized Bitcoin-backed credit facilities. What this means in practical terms is that affluent clients can now use their Bitcoin investment fund holdings as collateral to access dollar credit lines, exactly the same way they would use blue-chip equities or U.S. Treasury bonds as collateral. Bitcoin has been formally reclassified inside the banking infrastructure of the United States as a Tier 1 asset. That designation did not exist 2 years ago. It barely existed 1 year ago. And it is irreversible. Every future market cycle Bitcoin enters will be structurally different because of that reclassification. This is not hype. This is a legal and regulatory reality that changes how global capital can interact with this asset class, and the full implications of it have not been priced in by the market yet. I also want to address the broader crypto market context because Bitcoin does not exist in a vacuum, and understanding where Bitcoin sits relative to the broader digital asset ecosystem tells you a lot about where we are in the cycle. Ethereum is currently trading around 1,988, down roughly 2% on the day. Solana is sitting near $83 with similar pressure. XRP is around 1.44, relatively more stable than the rest of the market. The total crypto market cap is approximately $2.2 trillion. Bitcoin's dominance, its share of that total, remains elevated, hovering above 60%. That level of Bitcoin dominance is characteristic of a market in risk-off mode. When investors are uncertain, when the macro environment is creating headwinds, capital does not leave crypto entirely. It consolidates into Bitcoin specifically because it is the most liquid, the most regulated, the most institutionally embedded, and now the most formally integrated into traditional financial infrastructure. The broad altcoin rotation that defines the euphoric phase of bull markets has not returned, and it will not return until Bitcoin establishes a clear floor with sustained conviction buying from the large cohorts that are currently still distributing. The macro backdrop is something I always track closely because since institutional capital entered this market in scale, Bitcoin has become increasingly correlated with broader risk sentiment. President Trump's tariff announcements this week created measurable downward pressure on Bitcoin. The asset fell immediately after the tariff headlines on February 21st. That sensitivity to macro policy signals is not a sign of weakness in Bitcoin's thesis. It is a reflection of its maturity. It is now a globally traded risk asset that institutional participants actively manage alongside equities, commodities, and fixed income. When the Federal Reserve is uncertain, when trade policy is volatile, when geopolitical risk is elevated, capital moves towards safety, and while Bitcoin is increasingly seen as a long-term store of value, in the short-term institutional risk management frameworks still classify it as a risk asset that gets reduced during periods of macro stress. Understanding that dynamic is critical for anyone trying to interpret the current environment correctly. Bitcoin's short-term Sharpe ratio, which measures risk-adjusted return, hit a historic low of negative 38.38 on February 21st. That number is extraordinary. It represents a level of negative risk-adjusted performance that this asset has almost never registered. Historically, readings this extreme have marked the final stages of capitulation phases. They do not guarantee immediate recovery, and I want to be very clear about that. But they have consistently aligned with periods that, in retrospect, represented some of the most asymmetric risk-reward entry zones in Bitcoin's history. One more development from this week that I think deserves direct attention. On February 21st, Mara Holdings, one of the largest Bitcoin mining companies in the world, completed a $168 million acquisition of a 64% stake in a major European high-performance computing data center, finalizing a deal with a state-owned energy utility in France. This is Bitcoin mining infrastructure being built into the traditional energy and data center sector of one of the world's largest economies. That is institutional expansion of core Bitcoin infrastructure happening during one of the most pessimistic periods in recent market sentiment. The entities that build and operate Bitcoin mining infrastructure do not make $168 million capital commitments based on short-term price charts. They make them based on decade-long conviction about where this asset and this network are heading. So let me give you my own read on where this all goes from here. And I want to be clear that this is my analysis based on everything I have studied. It is not financial advice, and no one should make capital allocation decisions based solely on any single source, including this channel. Based on the full picture, the on-chain divergence between retail accumulation and large holder distribution, the institutional flow data showing selective buying at strategic levels, the structural reclassification of Bitcoin inside traditional banking, The K33 research framing of this is a late-stage bear market that closely resembles late 2022, the technical setup showing bearish momentum exhausting but no confirmed reversal, and the macro headwinds from trade policy and Federal Reserve uncertainty. My view is that $60,000 is the line that defines the next chapter. If that level holds over the coming weeks and ETF outflows begin to decelerate, the market has the structural foundation to attempt a move back toward $75,000 to $77,000. If $60,000 breaks, the market needs more time to complete its reset, and patience becomes the only rational posture. But the long-term thesis, the one that sovereign wealth funds, major banks, and the most sophisticated quantitative trading firms on the planet are quietly positioning around, that thesis has not changed. What changes during these phases is not the destination. What changes is who holds the coins when the next chapter begins. And right now, the data is telling us that patient, capitalized, long-horizon hands are accumulating while anxious hands are exiting. That is how every major cycle in this asset's history has set up. Not with fanfare, not with headlines calling the bottom, quietly in the data. If this level of analysis is what you have been looking for, hit that subscribe button right now, because every single day I am going through every piece of available market data, on-chain flows, institutional positioning, macro signals, technical structure, to bring you the most complete picture I can build. You will not get noise on this channel. You will get the work. And now I want to hear from you. What is your read on where Bitcoin goes from the $67,000 level? Do you think the large holder distribution pressure breaks before $60,000 is tested again? Or does the market need one final flush before the real accumulation phase confirms? Drop your analysis in the comments below. Not just your price prediction, but your reasoning. What signals are you watching? What data are you tracking? What is your thesis? The best conversations I have had in this space have come from comment sections exactly like this one. See you tomorrow with the next update.